Hello everyone, George DeSantis here with a look at the market for the week ending November 10th, 2017. Before we get into the stocks, I just want to say a heavy thank you, a big thank you to all those veterans who served in all these many wars that we've had over the past so many years. So thank you to all of you for your service. And before we get to look at the charts, we'll take a look at the disclaimer. The disclaimer simply points out that this is not investment advice. This video is simply for educational purposes only. So the first chart we look at, as we often do, is the weekly chart of the S&P 500. Now, if you examine the weekly chart of the S&P 500 closely, we'll find that there are conflicting signals here, mostly bullish with one major bearish indication. So let's begin. First of all, we have a nice run up here in the S&P, and since then we've had a consolidation. Now, like Larry Williams says, markets like organisms, they have to breathe. So they have to breathe, and the market is breathing here at the top. One way to look at it. The other way to look at it is that we have a bearish divergence. Let me give you the bad news first. Bad news is we have a bearish divergence of MACD. Market made a high here. MACD made this high. Market went up and made a new high. Well, actually, the market went up here, pulled back a bit, and the bears took it down. Okay, now we have a rally from here, and MACD makes a lower high than this high. So we have a bearish divergence because this is a new high of MACD as the market made a high. As the market pulled back, and as Alex would put it, the bears broke the back of the bulls by pulling them down below the water here. And when the market rallied, when S&P rallied, MACD couldn't take it up as high as this one here, as high as this previous high. So that's your bearish divergence. That's the major bad news in a sense. On the other side of the coin, the bullish argument would be, first of all, we have the 4 EMA above the 9 above the 30. So insofar as moving averages are concerned, the market is in an uptrend. Also, RSI 12 is looking very strong here, very bullish, above the 60% line and very far away from 40. Williams percentile remains not only above the 50% line, but above the 20% line. So that's very bullish. So you have these three indications of bullishness here, plus the fourth one, which is the directional movement index and the ADX, and that is bullish because you see the dots are increasingly higher, and the green line, DI plus, is above DI minus. So except for the bearish divergence of MACD, which we should not ignore completely, the chart is still looking pretty bullish. So now let's take a look at a daily chart. On the daily chart, we can see clearly that we also have another divergence here, because as the market made a high here, we had this MACD high. Bears broke the back of the bulls here, and now that the market's making a new high, MACD is making a lower high. So let me just draw that line in, and you'll see that this is a bearish divergence also on the daily chart. Now these divergences don't always work out as indications of a coming correction, but you shouldn't ignore them, especially on the weekly chart. We shouldn't ignore them. Let me show you another daily chart, and I'll have to get rid of this one first. So let me move it away from here. Now here's another daily chart of the S&P 500. And what this is showing us is something that I haven't shown you before. It's called the Ishimoku cloud. And this is the cloud here that is shaded in green. I can't explain it all in the few minutes we have. But if you're interested, you can go to the internet and read about it. What I really want to point out is that, as Larry McMillan indicated in his newsletter last Friday, 2565 is support. you can see that this hammer found support at 25.66. So, and this also is another hammer that found support in the same area, exactly 25.66. So Larry McMillan is calling for support at 25.65. His analysis is indicating that as long as we hold this 25.65 support level, the market should continue to rally. And as long as prices are above the cloud, usually we continue that uptrend. So we have two hammers. We have the market above the cloud, and we have a support level of 25.65. So my bet is that the market is going to hold at 25.65 level, but that's to be determined. So let's take a look at some individual stocks. As usual, we'll start with Apple. Many of us own it. And what we are seeing here is that Apple is overbought according to the regression channel, the 3 lines. It's where it's above the 90% line. It's at 97. If you look at the trend lines, though, the 4, the 9, the 30, notice that it's simply consolidating this nice gain that it made here. It's consolidating those gains, and hopefully it can ride this upper band here for a while. So we'll see how that works out. But Apple is certainly overbought at this time. However, we have a seasonal play coming up here in this area here, November 12 to November 26th. 11 out of 12 years, Apple's price been up. And you can see that it's been up 6% last year and 2% the year before, 7%, etc. So that's so far as Apple is concerned. Let's look at another. And here's Facebook. What I notice here is that the earnings line is very strong. I mean, they've been beating the earnings estimates continuously. And so even on this 6-month chart, you can see the earnings accelerating. So earnings are accelerating at averaging a gain of 82% over the 6-month period. And price is only growing at 47%, at a rate of 47%. So usually price will get caught up to earnings or vice versa. And you can see consistency of price and earnings is very high. Now look at the seasonals. We have a seasonal play just like Apple, almost the same dates. From 11/13 to 11/29, we have an 80% win rate. But in the last 3 years, it's been up 5% at least. So the average profit is about 9% if you go back further with some of the outliers. So Facebook's looking very strong still. And the other thing I wanted to show you on Facebook is that price is now in the buy zone between the 9, the red line, and the 30, which is the green line, the green moving average here. So it's now in the buy zone. So if you don't own Facebook, might be a good time to be buying it. Let's look at another one. Now let's take a look at that stock that Christopher pointed out to me. And it was the #1 rated stock on the IBD 50 last week. It's #2 this week. But boy, did it have its run up here. And so now it may be a little bit overdone. I noticed on the other charts on TC2000 that because of that huge run up, it went through a little consolidation. And we could see it here too. You see this run up and a little consolidation, then it shot up again on Friday. So I wouldn't be too anxious to buy it right here because it's very overbought. However, the stock has been doing fantastic. There's a seasonal play too at the end of the year, 12/17 to 12/31, the last 2 weeks of the year. So what a hell of a run up, which I haven't had it. I didn't have any cash to buy it, but it was a hell of a nice play. And we'll take a look at another one that had a beautiful run too. And here's that other stock that had a lovely run up recently too, Align. That's a company that makes the plastic retainers that kids and adults as well use to straighten the teeth, you know. Well, boy, look at this gap up here. Then it consolidated, ran up again, consolidated again. I wouldn't be surprised if it continues to go higher from here. But I'm a little concerned about buying it all the way here because it's so overbought. Is there a seasonal at the end of the year? Yes, there is. 11.21 to 12.10, an average of about 8% or 9%. So that's another one. Let's take a look at something else. And here's a chart of Green Dot, one that Laura recommended. And you can see it's overbought. It's very similar to the other two we just looked at. It's overbought. However, it came out with damn good earnings. Zacks rated it either a 1 or a 2, I don't recall now. So it's very highly rated by Zacks. It gapped up here and then is consolidating now. I would wait for a pullback for any one of these three stocks, whether it be Green Dot or Line or Universal Display, which is OLED. Let's look at something else. The stock that many people own is Costco. And after the scare that Amazon is going to put them out of business, it became oversold, rallied from there, and is now overbought. However, it's still looking pretty good, and I would buy it on any pullback, but I don't own it myself. The seasonal is there's a seasonal play at the end of the year here, November 20th to December 5th, and it's about an 83% win percentage, average profit of 4%. So that's another good looking one. But again, many of these stocks are overbought. Here's another stock I'm keeping an eye on, and that is Arista Networks, ANET. It's rated number 1 on the IBD 50 this week. Universal Displays, or OLED, is number 2. And this stock has also had a nice run up here. It's overbought, so I will be looking for any kind of a pullback to accumulate there, to buy some stock. Now, Williams percentile, you can see how it spiked down and the market took off. When Williams spikes down, price tends to move up. Let's take a look at the seasonal and see what we have. Not too many years of data, just a few, but we do have a short, a short in November, this month, the 28th of November to the 12th. So I would wait until next year to take a closer look. I didn't notice the short here, but that's the way it is. It's telling us we shouldn't be too interested right now, but keep an eye on it. Another stock that many people own is Home Depot, and this is Home Depot's chart. What I notice here is that Home Depot rallied quite a bit here, pulled back somewhat, and hit the 90% line and pulled back to the 50. And now what is happening is it seems to be finding support right here at about 164, somewhere around here. So I'll be looking to see if that could if you get any indication that this thing is moving higher from here. So maybe a buy stop order above this level, somewhere around 165, 166, maybe a good idea. But I'll be keeping an eye on Home Depot. Now let's take a look at Twitter. Terry mentioned it to me and I've been looking at it. As far as Twitter is concerned, we can see that it came out with pretty good earnings, I believe, or better than they expected anyway. And it gapped up and went up again the next day. Since then, it's pulled back to the 90% line, but it seems to be in the buy zone. It was in the buy zone here and it started rallying again. So Twitter is looking like a good one to keep an eye on. And I want to show you another reason why. Let's close this off. And here's a chart of Twitter on StockSpotter.com. There are some free indicators and so free screeners and indicators. What is showing you here is that a swing setup was spotted at Friday's close. This indicates a possible near-term bullish upswing. When you get this trough here and momentum drops, usually you get a swing setup. So that's all for now, folks. We only have 15 minutes to this. And you can visit this site anytime you want, just StockSpotter.com, and use these free ones here. These are the top, technical and free screeners. There's a limit to how many you can look at any one time. Have a great weekend, and we'll try to do this again next week. And let's hope that the market continues to treat us kindly. Bye-bye.